Hello, everyone. Welcome to Luke and Papa's Investment Club. My name's Luke.
And I'm Shiraz. Welcome and thanks for listening, guys.
One of the reasons why we're doing this is because me and my dad, we've always informally talked about stocks and bought stocks together, and this is a way for us to formalize that and actually invest together.
Yeah, and I think while we were doing a pretty good job, I think it was been a little bit hard for us to have monthly meetings and to have structure. So we thought maybe if we record these, maybe we'll get really disciplined about it. Does
Yeah.
that sound right?
Yeah, it sounds about right. Hopefully we can beat the market together.
I think there are some people who are skeptical, right, Lukey?
I would say so. A lot of people claim that it's an efficient market and, just put all your money in an index fund. Don't worry about picking stocks. Like, there's this famous a monkey who threw darts at a dartboard full of stocks did better than like Wall Street stock pickers, but we want to try to prove that wrong.
Yeah, I think they're all saying efficient markets, you're kind of crazy to pick stocks yourselves. How could you possibly know more and have an advantage from people at Goldman Sachs or wherever who are just studying every name all the time? So I think let's see. The goal will be to beat the market, and we'll do some work, and we'll present each month how we're doing.
Yeah, and before we get into it, I just want to say this isn't investment advice. It's for educational and entertainment purposes only. And I also want to say we're sticking to a growth style of investing. We're not doing any day trading or options. We're just long-term, good quality growth stocks.
Yeah, that's a great point. There's so many different styles and ways to invest. So, to make our lives a little bit easier, we're really focusing on, what we're calling high quality growth stocks. And what we'll do each month is try to look at our whole portfolio, and then before making a buy decision, actually do a deep dive on that specific stock and analyze it with, a very specific framework in mind.
Yeah, to add on to that a little bit, here's our portfolio, and we're not going to go too into it right now, but we've been putting in a collective $50 every week into this account, and we've collectively been choosing which stocks you want to buy. We have a total return rate so far of around 27%, which is very good so far. That's beating the market. And our future intention for our portfolio is, we're going to keep putting in money and we're going to make these videos. And every month we're going to pick a company and we're going to see, do we want to buy more, sell more of a certain company? Does that sound about right?
Yeah, it sounds perfect. So, to say it a different way, maybe there's like two parts to each monthly meeting. The first part is going to be very short this month because we haven't really done all the analysis, but we hope to show you our portfolio each month just to sort of see how it's going. And then as stocks have gone up or down, or maybe different things have come out from each of the different names, maybe they've had an earnings release or done an acquisition or something like that, we will aim to have a point of view as to which stocks we should continue to hold. Are there some stocks that we should consider selling? But we haven't really done all the work to go into that in depth today.
Yeah. So to get into that, our stock for today's meeting is something called NICE. Would you like to tell us about that, Charles?
Yeah, I'd love to. So we're not experts, but we'll try to tell you. NICE is a company headquartered in Israel, and they sell to enterprises, which means they sell to big companies, and they have really three types of things that they do. It's a software company, first of all, but their primary focus is on customer experience. So they'll sell into call centers and provide software to help automate and improve the call center experience. They also work in their second segment, which they call financial crime and compliance, so finding fraud and crime. And then the last thing is kind of public safety and justice, which is about kind of policing and also, again, like catching bad actors. They're primarily a cloud software company, but they do have some service revenue and a little bit of what they call product revenue, which I think is more like an on-premise, which means software that's installed at the customer site. They have about 25,000 customers. They actually sell to 85% of the Fortune 100, which is
Wow.
pretty amazing. and they have about 9,000 employees.
Now, how do we analyze if NICE is a high quality growth company? First thing we want to look at is the historical sales. What sales are is just the company's total revenue. Revenue just means the total amount of money a company makes, not including expenses, not including anything they spend, just their total amount of money. And what we're looking for here is a relatively straight line that's increasing. And if you look at the historical growth sales for NICE, you see it's insane. It's almost a perfect straight line increasing. This is exactly what we're looking for sales. It's historically growing at a rate of 11.3%, and if we look at the last 5 years, they're growing at 11.7%, a relatively consistent growth rate for sales. Now, the next thing we want to analyze is historical earnings per share. Now, earnings, that's total revenue or sales minus the company's expenses. So it's how much money they keep. Its historical earnings is 10.7%, and it's steadily increasing. The line isn't as straight as sales, but if we look at the last 5 years for earnings, you can see there's an insane amount of growth for this company, 15.5%.
I also really like, Luke, how the growth seems to be accelerating. If you look at 2021, it seems like that growth is even accelerating. So if we actually just look at the last 3 years, it goes up to 31%, which is obviously very fast growth.
Yeah, I really like that.
So our analysis really hinges on two big picture questions. The first question is this a high quality growth company? I think based on this analysis, we could definitely say for sure, yes. You agree,
Yeah.
Luke?
I agree. This company definitely shows their very high quality growth.
And now the second question is going to be around valuation, or like, is this price the right price? Is it a good entry point? How are we going to do that, Luke?
Well, how we're going to look at if this is the right price for a certain company is we're going to examine the PE.
What's the PE?
PE stands for price divided by earnings, or earnings per share. And we went over earnings per share. It's the earnings divided by total outstanding shares of the company. And for PE, you take the current price that the company is selling at today, and you divide it by the last 4 quarters of the earnings, or the trailing 12 months, as you often see it referred to.
So is it basically like saying, all right, we found a high quality growth company, but we're not really sure if it's a good price or not because we don't know if it's expensive or not. So PE is going to give us a kind of a read into how expensive it is, and based on that second question, we can make our decision whether to buy it or not.
Exactly. Just because it's a high quality growth company doesn't mean you should buy it right then and there. You want to make sure it's selling at a fair price.
So we're not going to go through all the work we do, but the way we're going to get to this sort of view as to whether the price is okay or not is we're going to look at historical PE ratios. We're going to look at the last 5 years, and then we're going to project forward on both like a forward-looking, what we think is a reasonable high PE and a reasonable low PE. And we're going to do the same thing with earnings per share. So we're not going to go through all this detail here, but what we'll do is show you the result. So again, we're going to look at the historical PE, and we're going to make some assumptions for what we think 5 years out would be a reasonable high PE. And then we're going to also say, okay, what if things aren't going that well? What if the market doesn't love NICE? What's a low PE that would be reasonable? And then we'll do the same thing with earnings per share, looking at the historical earnings per share chart that Luke showed, and we basically have like a reasonable high assumption for earnings per share and a reasonably low earnings per share assumption. And this will give us a range of future stock prices. Did I get that right, Luke?
Yeah, so basically, to summarize what you just said, we're basically going to try to predict what a high price might be and what a low price might be. And from there, we can basically determine whether or not we should buy the stock. So for our prediction for the high PE, we used 40. And this is notable because this is a lot less than the historical high PE, but we still thought it wouldn't climb higher to 76 like the last 5-year average was. And we thought the earnings per share at a highest would grow to 10.
Which is good, right? Because if we see a 5-year average of 76, it feels like we're being somewhat conservative to use 40
Yeah.
because that's a lot lower than the 5-year high average.
Yeah, I think using a PE of like 80 or something higher than the last 5-year average would be unrealistic because it'd kind of give us a goal that we wouldn't be able to reach. Now, for the low PE, we used a PE of 20, which again is lower than the historical 5-year average. So we're just being conservative here. We're leaving a lot of room for error based on the last 5 years, wouldn't you say?
Yeah, absolutely. I mean, this is a software company. It's a growth company like the charts you showed. I mean, a lot of growth companies, trade at an incredibly high price earnings ratio. And, 20 is very low, as we saw, compared to the last 5 years.
Yeah. Take Salesforce, for example. They have a 58 PE.
Yeah.
And so with these numbers, we calculated a buy, hold, and sell range.
So what this is a tool that allows us to sort of visualize where the current price is here versus where the forecast price is based on the assumptions we made. And you can see, right, basically the bottom 25% right here is what's called the buy range. The middle 50% is the hold range, and the top 25% is the sell range. At the very top of this bar is our forecasted high price, right? So we're saying like 5 years out, if the earnings per share are based exactly at our high estimate and the PE is our forecasted high, the price, the stock will trade at $400 per share. If everything comes out more like our low estimate, so our low price earnings ratio and our low earnings per share, then the forecasted low price is 129. So basically, at the current price of 161, this is telling us there's a lot of upside here. If a stock is trading in the green range at the bottom, that's our buy range. And obviously, if it's trading at the very top, that's our sell range. So based on this analysis, and again, as Luke explained, I think our assumptions are relatively conservative. We're pretty excited about this, right, Luke?
I definitely am. And as you can see, it's not like we're on the edge of the buy range or like barely in the hold range. We're very far in the buy range. It's a 6.3 to 1 ratio, which just means if you look at the sell and the hold, that's like 75% of the data. So if the buy range is 25%, then you want to have a 3 to 1 ratio. Is that right?
Yeah, exactly. And this is much better than that 3 to 1 ratio. So I think we're pretty fired up about this. Maybe it's a good time to say, look, this analysis is not comprehensive, and obviously there's a lot of other factors. Some factors are positive. So one of the things that we noticed in our research is that NICE is doing a share buyback. Will you want to explain what a share buyback is, Luke?
Yeah, sure. So public companies have shares, and they might issue shares to a CEO. When you buy a public company, you're buying shares of that company. And so a share buyback means that the company decides to buy shares. And what's the significance of this? You want to explain?
Yeah, it really can bolster the earnings per share. So if you think about EPS is earnings per share, it takes the company's total earnings and then divides it by the number of shares outstanding. So if, as Luke said, the company is buying back shares, making fewer shares outstanding, the earnings per share will actually go up. And that is what is, in our view, going to drive the ultimate stock price.
Yep. With an increase in EPS, we project an increase in price. So
exactly. So that's a good thing that wasn't really part of this analysis. There's definitely some risk factors. So maybe we'll just touch on a couple here.
Yeah.
The company is not headquartered in the U.S. Luke, why might that matter?
Well, the company is headquartered in Israel. And as I'm sure many of us know, the Israel Gaza conflict might play a role in fear of investing in an Israel company. There's many people who don't want to buy, companies that might be in active war zones, or they think there's too much risk associated with this. But I think some good news with this is also the ceasefire that recently happened. I think that might be very good for them. But again, it's not in a stable place like the US that many people are very keen to buy. Some people definitely think twice before buying a company in a place like Israel.
Yeah, 100%. Although I do think the other thing that was comforting to read about was the vast majority of NICE's revenue comes from the US. So I think that probably provides some protection as
Yeah,
well.
it's not like we're buying a company that's only dealing in Israel. They're very comfortable in the US. And I think another risk factor might do with the CEO. Do you want to explain that?
Yeah, we just learned on the last earnings call, listening to the last earnings call, that there's a new CEO in place who just came on board maybe a month ago. And, we're not doing deep research and understanding his historical performance, but obviously a change in leadership can be disruptive. It could lead to key people leaving. It could lead to a change in strategy. So it's probably just worth noting as a risk. It could be a good thing too, but we thought we'd just mention it as a risk. I think the third risk that we thought worth mentioning is it does seem like even though the vast majority of their revenue is cloud based, they do have a little bit of on premise product revenue, and that could also be a little bit lower margin, a little bit more costly. Um, yeah, maybe this is enough for today. Should we? What do you think, Luke? Are we good to make the decision to go forward with this?
Yeah, I think it's plenty for today. And this is our first video on the channel. And so we're always open to suggestions and we're always looking to learn and improve. And in the future, we'll do a lot more analysis on our full portfolio and maybe we'll go more into depth into a stock or less. But sounds good to me.
Yeah, perfect. Yeah, if you like it, please share it with a friend. And like Luke said, give us your thoughts or feedback. We'd love to make it better and keep it going. Thanks for tuning in, everybody.
Thank you.